All right, guys, how are you doing? Okay, I'm going to talk to you about doing financial planning with the Canon Financial Insurance Agency LLC, made simple via the new way 2000 since 2020 March 27th. I believe that's the day that COVID-19 happened. But ending that introduction, going on to what you need to know is that there's different types of leads out there. That's what we want to talk about through the whole sessions. There's also different types of financial retirement planning. We want to talk about that too, through the whole stage of the volumes of sessions that we have here for financial professionals only. You have to be invited to be in this. The first person that we're training officially is Mr. Gustavo Z from Hawaii. And the reason why we're doing this is that it's a matter of importance. The belief is way up there now. So, just a little bit about myself here before we go on. At age 11, wow, but I'm not going to talk about all the other ages, right? But at age 11, my father bought me an encyclopedia about this thick. And what I liked about it is ET was on there. So I was reading about that. Then I read about the the careers that are available, and I saw life insurance agents that make $44,000 a year. Then bakers make around 20,000. That was in 19 1981 when I was 11 years old. So anyway, so then from there I saw Smith Barney videos. I saw other types of videos. How you doing, sweetie? I saw the Smith Barney videos. I saw Travelers videos. I'm only doing like a 15-minute session. And I was very intrigued from there. So whenever there was a sort of session happening in school of what your career is, I didn't know, but I was already being focused on what I should be doing. At age 18, I went to Mexico with my aunt and uncle, and they were doing import export. They told me when I came back that I should go into helping the consumer out and doing some sort of transaction. That would be a wise decision for me to do. And they owned a lot of land, and they had a lot of money and income, and that attracted me. Who wouldn't that be attracted to? I wanted to live that lifestyle. So when I came back, I started working with a company that eventually bought out Smith Barney, and I actually worked for Travelers. And here we are today, the year 2020, being very fascinated to become that I wanted to become a stockbroker and work in one of the buildings in New York or Chicago, the trading system, and do transactions over the phone. And here we are where we're at today. So if you're that person that wants to do field sales, and I'm gonna hit home run right here, guys. Okay, I'm gonna hit home run. If you're the type of person that wants to be on the field, and that's great, you can make some great income doing that, but it's gonna take 60, 70 hours a week, so you can make over $100,000 a year. Um, and that's dependent on what type of transaction you're going to be doing. Financial planning with insurance, financial planning with annuities, financial planning with different types of other accounts that are available, variables, and so forth. We're not going to talk about products on the variable side. We're going to stick with the insurance session for today, keeping it on the Nova side. It's going to take you many, many, many manpower hours because you have to determine the what type of lead to work with. There's different types of leads, and there's also a different type of mentality and type of explanation. So you could capture the client and create something called reciprocity. And if I pronounced it wrong, then please just let me know. Reciprocity, okay, something that I've always done, but never knew I was doing it until like 2 months ago. I heard of the word through a pension company called CalPERS. So they practice reciprocity. Anyway, so reciprocity can be done in many, many ways. All right. So now we're going to talk about qualified versus non-qualified. Best thing to do to learn the qualified type of accounts is to go through a session on continuing education and learn, obtain a course so that this way you could have 3 hours of learning the differences between non-qualified and qualified. It's a little bit complicated for the reason that you got to understand that when we're talking about qualified pro, product services, not products, but qualified services. Qualified is an IRS regulated term, which includes qualified accounts such as IRAs, traditional IRAs, Roth IRAs, simple IRAs, which are for people that own their own businesses, 401ks, simple 401ks, solo 401ks, TSPs, 403bs, 457s. There's others as well, a couple others that I'm not recalling that we don't use, obviously. So there, those are the 403. Those are the qualified market. Actually, 457. It's you can. I consider it a qualified account for the reason that you could roll over 457 to an IRA. So it's allowed, even though 457 is a government plan, and I'm not going to get too far into that. You're not going to deal with 457 plans right now. We could go on to another session on that. So you have to understand that IRS labels are an IRA, a traditional IRA, a Roth IRA, 401k, 403b, the TSP programs. So those are profit sharing plans. Those are the IRS labeled qualified accounts, as well as defined benefit programs, which you will see them from time to time. Defined benefit plans pretty almost became obsolete after 1989 due to ERISA, and the only individuals that you will see with defined benefit plans are nonprofit employees such as schools, municipalities, correctional officers. I already said it, I already said what. So you'll see stuff like CalPERS, CalSTRS, FERS, and then in each county, they may have a different type of third-party administrators, such as ICERS in Imperial County of it, Imperial County Employee Retirement System, ICERS. So those are defined benefit contribution programs, which are qualified. And as I said, you won't see them. You will see them, but they're something that you wouldn't want to roll over unless the person has severed from that employer and moved on into something else, and they cannot collect a certain amount of income for the rest of life. It could be pretty much they would have to work a certain amount of time there, and you would have to be careful before you try to roll that over. And like I said, you don't usually get those. Now, there's non-qualified accounts. Non-qualified accounts is an IRS word. Also, it's an IRS label. That means that the non-qualified account acts as a tax haven, such as a qualified account. So it acts as a tax haven. How does it act as a tax haven? Is not qualified. Well, when you see non-qualified, it means that you can't roll over a 401k, 403b, IRA, Roth IRA into something that has no label. It has to go from in kind, from one qualified to another kind, which is a transfer. It could be an exchange, or when you're changing the label, 403b to 401k, 401k to 403b, 403b to IRA. It could be any way like that, zigzag, however you want to look at it. But that is a qualified plan. But you can't go from a qualified to a non-qualified, or a non-qualified to a qualified. You cannot do that. You cannot commingle the IRS regulations. So that's the number one thing that you're going to have to learn there. Even though I taught you majority of the concept, you really have to understand more and more detail the exchange of the contracts, the in-kind transfers or transfer, rollover, what would that be? So that this way, when you're talking to a client, you would be on it and they would be able to reciprocate the knowledge with you and take advantage of you. When you're with a client, you want to be able to I'm going to put it to you in this scenario. You want to be able to let them know that you are the person that they need to confide in, give you all their details, so that this way they could do a transaction with you. Usually 80-90% of the time, um, more like, it depends on the type of client that you're dealing with, type of lead. Um, you won't be doing the transaction immediately. They might be under some sort of time constraint. So that's what you got to look at. And so you got to be able to work with your leads. Okay. So now I'm going to explain it to you in this scenario, so that this way you can understand more of the leads and where you have to be at mentally as well. So when you're talking to a lead, you have to find out what kind of lead you're working with. There's something called senior leads that we work with, and you don't know if this person. Let's just give you an example that this person has a tortilla factory, but the tortilla factory is they make tortilla. They make the devices so that the tortilla factories can work in. Okay, let's skip that one. Let me make it simpler. Tortilla factory assembly line. So you don't know if that person that you're going to be helping with, metaphor only, hypothetical only, is working on the assembly line, making sure that they're packaged. Okay, they could still have an IRA or 401k to roll over. Okay, but it may be $50,000 or $100,000. In general, it's $45,000 on the average. Now, there's also a manager, the manager to that assembly line or that team or the whole warehouse. Or they may have more. Okay, they may have 200, sometimes 400,000. Okay, dollars, and then depending on the level of intelligence in the investment world, and factoring the importance of their retirement, they probably would have more. But you're never going to know unless you know what kind of questions they ask, and you can't be so intrusive in the beginning. Now there's there's another one that's a little bit upscale, which is the owner of that tortilla factory that has all these, the employees, a manager, and then the individual assembly line employees. So when you get a lead, you don't know you don't know where they're going to be at, whether they're going to be on the labor force, whether they're going to be administrative, or they're going to be the owner, or they're going to be a part owner, or so forth, of that warehouse. So you have to have a setup in your own terms, so that this way you can ask questions of this person, and they could respect you. So you have to know the differences between qualified and unqualified, so that you will be able to work with the different type of leads. Now, I'm going to give you an example based just exactly on what happened. This is not made up whatsoever. Over the weekend, we were on 8/24, so this happened on 8/22. On Saturday, I got a lead, and this person really wanted to invest money for. He wanted to own an annuity, but he doesn't know what an annuity is. He just clicked on the lead that he wanted information on annuities, so I called him up right away. He said on the form, it says he wanted to invest. All right, so I called him up right away, but it turns out that this person wanted to he wanted to invest money. He's 51 years old, but he's buying homes for his children. So he's liquefying some of his real estate, so that this way he could put a 5%, 10% down payment on the homes. With the differences of some of the homes that he's liquefying, he's selling his assets. So what he's going to be doing is going to be buying a automobile, $50,000. And the leftover is going to be invested into what he wants is stocks. So that's what he told me. So what would you do if that somebody would tell you, I want to invest in low stock? Oh, I'm sorry, that's not me. You could go somewhere else. Now, what kind of account is that? Would that be a non-qualified account in stocks? No, it wouldn't. Okay. You're not allowed to talk about it if you don't have the material, but you should know about it so that this way you could lead the person back into you. So a stock would be more of a discretionary fund, because they're using discretionary income. They already liquefied it. It's going to be in their bank account and it's going to be discretionary investment. So that would be a discretionary account, that's not tied into a qualified or non-qualified, because it's not going to be a non-qualified is usually an insurance product. I hope that helps you out. Discretionary would be more of a mutual fund or a stock. All right. So you have to know that. And now don't tell him that, because you're not allowed to talk about that. You have to know about it. So now in this situation, I had to break him down a little bit more instead of being intrusive and leading him directly and going for the throat. So I said, okay, so you want to invest in stocks. So there's two things that you could do. You could go to a stockbroker and you could invest in stocks, or we could continue talking about other options. But let me ask you a question. So see, I pushed them away, but I'm pulling them back in. So, but I'm also putting myself aside that I don't deal with that. So he says, okay, what's your question? See, now I'm bringing him back in. Reciprocity. It's a strategy. So now brought him back in and I said, okay, what does your wife want? I think you're married. You mentioned you have children. I don't want to assume. Oh yeah. She wants something guaranteed, he says. There you go, right? There you go. What else does she want? Well, she wants to put it away for at least 10 years. There you go. So now we know that we could put that money into a non-qualified, depending on the amount. And on an IRA, there has limits. For a married couple, it's $6,500 on an annual basis. But since this person actually owns a warehouse, he rents a warehouse that makes tortilla machines, and he distributes them around the world or around the United States and Mexico. And maybe 1% or a small fraction to the world. 10% goes to LA, he tells me. So there you go. He's an owner, but retirement isn't his forte. He doesn't really care about that. He's going to work forever, he says. So now I found out what the money was, the different amount that he has. So he told me it was going to be about 50,000, and I said, okay, great. So see, I already established some rapport of what he wanted, and I just gave him the idea of, look, sir, you could go do two ways. You could go with the discretionary way, which is going through stocks, somebody else, but there is a possibility that you will be losing your principal. Or you could go your wife's route, which is having a guaranteed type of a investment vehicle, retirement vehicle, and having a huge rate of return that I could talk to you about with some of our products that we have. But let's talk about that with your wife in place. When will these funds be available? Oh, it's going to be available on September 15, 2020. That's when all the real estate escrow is already expected to be liquefied, funded. Okay, great. So let's go ahead and put you down for, I'm going to call you next week so you could talk to your wife about this, and we can look at the calendar and we'll discuss on 9/16 when everything's liquefied, and a strategy to do with you and your wife. So that was the lead that I got, and in a matter of 15 minutes or less, I was able to establish all that. Some way to create reciprocity. I tied it in, and I tied it in with this. If you own a business with a simple IRA, you can have as much as $50,000 on a 1-year contribution and have a pre-tax, tax deferred, and tax deductible event through a qualified account, which is a simple IRA. You would qualify for it, and then I just explained a little bit of that to him, and I tied him in to that. I said, if you were to go somewhere else, it wouldn't be able to talk to you about non-qualified or qualified, and understanding where to go to your goals. The goals that I'm going to help you out with are with index index accounts through an insurance company. That's where they're guaranteed. But also, we're going to be using IRS regulation strategy so that this way, if appropriate, you could get as high as $54,000 pre-tax, putting in pre-tax money, tax deferred and tax deductible. He says, "Oh, okay. I never thought about that. I always paid money on my investments." And I said, "Okay, yeah, it's kind of like real estate. You know how you put your money in, and then when you liquefy your money, that's when you pay taxes." Yes. Okay. Well, that's what we're looking at, because if you put your money somewhere else, okay, in a bank account or an other account doesn't have this IRS label, then you would be paying taxes you won't have a pre-tax, you will be paying taxes, subject to taxes on an annual basis. They're mandated for you to be reporting them, and it will not be tax deductible. So it's a matter of you wanting tax deductible or not having tax deductible. You don't want tax deductible because you want access to your money in 1 year, but your wife wants it in 10 years. So I'm not going to be in between both of you. What I'm going to do is I'm going to just do a presentation with you and your wife for 15 minutes, and we could go from there. Is that fair? Is that good? That's very good. Okay, great. So on a Saturday, I was able to give them all that information in about 15. I doubt it was more than 20 minutes, but I wrapped them around, and there we go. So we have close to $2 million to finish up by the end of the month of people's money being invested with us. And we went from $80,000 1 year to $110,000 the next year to $150,000 the next year to $190,000 the following year to $230,000 the next year. Now that this happened and I grasped everything via virtual sales and had a better understanding of a psychological sense on how to help out a consumer, and especially this virtual world, we're jumping from $200,000 to $500,000 over, because we have many more clients to help out. So we'll definitely do over $10 million in rollovers this year. So it's up to you to keep following us and understanding more of what we do. And do call me at 888-604-6620. Leave a message. I have about 25 appointments a week that last between 1 hour to 3 hours. So I would average 2 hours each, because I do have some no-shows, and I do have some that last 3-4 hours if it's a second appointment. Okay. So the first appointment, usually I'm setting them up on starting up their package, and then the second appointment is to do the rollover, or I do the rollover all at once. But when we're looking at high volumes, it's usually, let me think about it. So you got to time in with an advantage to you that will make them remember you instead of you shopping them, going shopping somewhere else. I've already practiced this, and what happened was that I practiced this. And what happened was that when you don't do it right, you usually have cancellations. So when you have cancellations, that's the reason why you didn't grasp them. You didn't do. It was just practice. So when I say you didn't do your job, you did your job practicing, and the only way to succeed is by failing. Okay, successful people go through other people's defiance and your own defiance. So that's the end that I'm going to explain there. I'll go through more on that later. Appreciate you, and have a great day. Again, my number is 888-604-6620, 6620. We went at 25 minutes, but I hope you learned a lot. This is JR DeCannon. Have a great day.